profit. Sanjeev Prasad is with us, Managing Director and Co-Head at Kotak Institutional Equities. Sanjeev, good morning. Great to have you with us here. Thank you for your time. We're chatting after a while. I'll get to specifics in terms of earnings estimates, etc. But the big question for a lot of the local audience, every day, FIs have been selling and selling and selling. 2 months now. Yesterday, they were small buyers. What is your sense, Sanjeev? Any thoughts at all? Are we coming to the close of this episode?
No, it's hard to say, to be honest with you. But if you look at the FI flows, I think when most people look at the FI number, it's actually a very misleading number. So it's a negative $2.5 billion, calendar year to date. But if you look at the breakup of that between primary, secondary, active, passive, it looks like active secondary flows have been negative for a while now. So just to give some numbers, $2.5 billion negative calendar year to date. Out of that, you have about $12 billion of primary inflows, by the way. So if you strip that aside, the secondary numbers are actually much more negative. And you also had about $13 billion of passive inflows. So if you take that out, you probably have something like $25 billion of active secondary selling in the current year compared to the headline number of $2.5 billion. So that would suggest to me that many of the active fund managers have been negative for a while. And there are enough reasons for that. Valuations have been on the higher side for a while now. And you have seen the earning numbers have not been anything great. People, I guess, have found some opportunities in China in September, October. And I guess right now people are seeing a lot many opportunities in the US, I guess. So as far as emerging market active fund managers are concerned, the big challenge for them is absolutely no inflows. Because the EMs as an asset class haven't given much of returns for the last 10 years now. And the US market doing so well, strong US market, strong US dollar. And obviously the asset allocators are not inclined to look at EMs as of now. So I suppose this trend could very well continue unless and until the markets, settle at a level where valuations become a lot more attractive for active secondary market investors.
Well, according to you, and you're a completely numbers, fundamental focused analyst, Sanjeev. Where is the cushion? At what level will it interest investors?
You have to look at this market more on a stock by stock basis or cap by cap basis. So if you look at the large cap names, Nifty itself may not look very expensive. It's about roughly 21 times, 1 year forward kind of a number. So it looks okay, but keep in mind the fact 2 things. First of all, we are looking at pretty strong earning numbers for FY 2026 as of now, 16.5%. So whether that will come or not come, that's a big question mark given the cyclical slowdown that we have seen at least in the first half of this financial year. And second thing is, there are some structural challenges which have started to emerge in terms of job creation and so on and so forth. So you could possibly see more of a earning downgrade as we go forward. Third thing is when you look at the Nifty valuations, again, it's a very misleading number because about 50% of the net profits of the index comes from lower PE sectors. 27% comes from banks, about 5% from metals, 19% from oil and gas, which are, trading at between 13 to 15 P. If you look at the rest of the Nifty, valuations are very, very expensive. Beyond, I would say banks to a large extent, everything else is expensive, both on an absolute basis versus history, versus all the challenges that are coming up, versus earnings growth, whichever way you cut it, valuations across the board are, I would say, full to frothy in some cases also. So that's the challenge. You still haven't come to a level where valuations are starting to look attractive. So again, 2 more points I will highlight. If you look at the stock correction, they have either happened in sectors where you have seen massive earnings downgrades, right? Which hasn't really helped the case of the valuation, because valuations have stayed on the higher side given the fact that earnings are cut. And the second area where you have seen earnings down, where you have seen a massive price correction in the entire pack of what I call as narrative stocks. And many of them corrected between 20 to even 50% in some cases. I think they need to be significantly lower. The real value should be about 20 to 50% of the current market price, even after correcting so much. So the long way to go in many of these, mid-cap, small-cap, narrative kind of stocks. So that's the one challenge. The headline valuation will look okay, but if you look beneath the bonnet, there are a lot of challenges when it comes to valuations. At max, you would say, at best, we can say you have fair valuation for banks. In the case of consumption, outsourcing, pharmaceutical, IT, sectors, etc., and pretty frothy for the rest of the market, I would say.
Okay. Frothy in large parts of the market, maybe okay for banks. And the narrative stocks. Great to have you, Sanjeev, on the show as always. So let's talk about the narrative stocks. And if I get the hint correctly, I think this is exactly the space we were discussing with an analyst earlier. The PSU space, CapEx, right, sort of long gestation themes. If you could just elaborate on your thoughts on the so-called narrative stocks, what specific pockets are you referring to? Because the thing is, there's still a lot of ordering activity. I mean, look at the Hitachi order yesterday, or, Power Grid is getting orders. Railways are still dishing out some orders, as with defense. But again, I think the question is how much is still left on the table? So if you could just elaborate that point, narrative stocks still not good enough?
I think you have to look at the context of the market cap of these companies versus the profit numbers and potential profit numbers, assuming all the good news. I will give you a couple of examples. I mean, you talked about Kotak Shipyard in the morning. The stock had done well in the last 3 days. I mean, this is a company which is about almost 40,000 crores market cap now. The net worth of the company is only 50 billion rupees, 5,000 crores. So it's trading at 8 times book. Last year's profit was about roughly 800 crores. Yeah. So it's trading at 50 times P. What sense does it make, to be honest with you? You have companies like Hindustan Copper, 27,000 crores market cap, 3 billion rupees of profit last year, roughly 25 billion rupees on net worth. It's trading at more than 12 times net worth. You have ITI, loss-making company, trading at 27,000 crores market cap. IRFC, 2 lakh crore market cap, more than 4 times price to book for a finance company, which is, I don't even know, it's more of an intermediary finance company. That's it, right? Wholesale borrower, wholesale lender. So there are so many such examples, BHEL. I can go on and on. There are enough number of examples which I could narrate. I mean, I just struggle with the valuation of many of these names, to be honest with you.
I completely take that point, and I understand the pain, Sanjeev. But I guess the thing is, forget FPIs, but when there's like 40,000 crores of liquidity hitting the equity markets just from domestic, mutual funds. I'm not even talking about other institutions and insurers and EPFO and so on and so forth. But if there's that kind of money hitting, then I don't know, how do you wrap your head around the valuation argument? And I think the issue with a lot of investors is going to be how much cash can you really hold in portfolios, even funds, even mutual funds. Many of them are still sitting at 8-9% cash levels. Relatively speaking, aside from banks, would you look at buying anything in the market now?
You say understand the pain. I don't know if, I'm actually fine. I don't have any individual stocks in it. You'll find out the pain for many of the investors who are in the stocks, sooner or later, I would say, when the stocks eventually they will correct to 20 to 50% of the current, current market cap. So there is going to be a lot more pain in the market, I don't have much doubt about that, because none of these, valuation are really stable. Coming to flows, see, this flow is a reflection of expectation ultimately, right? Obviously in the market, somebody buys, somebody sells. There is no money in a secondary market at any given point in time. Why is so much money coming? Because investors have decided that they can, and they will always make large amounts of return in the market, which has been the case in point. Over the last 3.5 years, returns have been very good. But if you look at the last 6 months, returns have become pretty modest. 3 months, it's negative. And if things continue like this, and as the trailing returns start declining, you would assume that the flows will also start to come off. Flows is just a reflection of the expectation, and expectation based on whatever people have seen in the past. As of now, people are still looking at the rear view mirror, assuming you have a lot of money to make in the market and pouring in money. But obviously, there's no valuation support for most of the markets as we're discussing. Yeah, the stock prices can go up, but ultimately one has to look at value versus price equation at any point in time. And in most cases, there's a very large disconnect between price and value. In terms of the price is significantly higher than the fair value of the companies.
Yeah. You've used BHEL from the power space as an example. You've used that as an example to highlight some of the difference between value and price. But any thoughts on the space? By the way, we have the management of, it reminds me, Hitachi Energy. The management is coming up with us in just a bit. I mean, clear leader in their space. Stock's done very well. I don't know if you have any thoughts at all, Sanjeev.
I'm sure there will be pockets of, value, a value in the sense, the news flow would be positive. But whether it is sufficient to justify the current market cap, that's the call investors have to take. I mean, you want to talk about bail, let's assume 100% of all the orders which the government of India wants, 80 gigawatt, will be given to bail over the next 8-9 years, which is the target, right? And you do a simple math, you take, let's say, 60,000 rupees per gigawatt, multiplied by 80 gigawatt, that comes to 4.8 trillion rupees. You take a 5% PAT margin, you come to 24,000 crores. As the total potential profit pool for the entire industry over the next 8 years. The market cap for BHEL is 80,000 crores. I mean, you reconcile the math over here. Even if you take 10% PAT margin, it will come to 48,000 crores. So that is what I'm talking. And even not even discounting the cash flows, by the way. You are in this math, you're assuming all the profit comes today. If we discount 48,000 crores over 8-9 period, it's obviously going to be a much lower number. But that is our challenge over here. Anybody who's numbers focused, bottom up focused, it is very hard to reconcile the fundamentals with the kind of market cap people are giving to stories at this point in time.
I don't know, and that's a very nice illustration once again. I mean, I think, we need to kind of revisit that sometimes because a lot of, as you've, I think, written in your reports as well, a fair bit of narrative, etc., which, of course, has supported many of these sector stocks, etc. Sanjeev, thank you very much for joining us. Great speaking with you, and it's a pleasure. And look forward to our next chat.